welcome. We're having a little competition this morning, but perhaps others will flow in after the Greek Minister of Finance has finished explaining the euro crisis to us. This session is on the capital account, savings gluts and global imbalances. I guess I don't need to bring to everybody's attention the fact that we're still in the middle of the worst global economic and financial crisis since the Great Depression, and sadly I fear that it's not over yet. One salient fact, first pointed out I think by the BIS, but also by other scholars, most recently the McKinsey Global Institute. If you think a crisis is a time for deleveraging, think again, because total non-financial debt in the 45 largest countries is now 20 percentage points of GDP higher than it was in 2007. So far from deleveraging, we've been moving resolutely in the opposite direction, which doesn't give you a great deal of confidence about the future. And I think I would have to say that as you look around, there's weak spots everywhere. The US has got its problems, productivity growth, part rates. China's in the middle of a big transition. Transitions are always enormously dangerous. Europe, well, I needn't say much about that. Huge economic and political problems that they were just referring to in this other session. Japan, I think Abenomics could easily backfire. For those of you who remember the famous article by Sargent and Wallace about some unpleasant monetarist arithmetic, keep your eye open on that. And all of these problems, I think, are against a backdrop of a relentless increase in monetary base by central banks around the world. Well, this session is dedicated to investigating the international linkages that may have contributed to the mess that we're in, or perhaps even more strongly, whether in fact it was not current account imbalances and the savings glut that was actually at the root of this problem. In preparing for today's session, I must say that I was forced to go back and start reflecting on the character of the international monetary system and how that system actually allowed the kind of excesses that have taken place that have contributed so materially to where we are. And I think the answer is, and I hope some of the participants will dwell upon this, is that we don't have an international monetary system. We have a kind of international monetary non-system. There's no rules out there. It's sovkipa, everybody can do whatever they want. And they are. And I think what that means, basically, is that this international monetary system has got some very bad characteristics. One, there is, in fact, no automatic rebalancing of current account imbalances. It doesn't happen automatically. Secondly, there are material international spillovers from easy money in big countries. I live in Switzerland, so I've certainly seen what happened with respect to the ECB. And many countries, I think, have seen the implications of easy money in the United States. There are spillovers. A third characteristic is that the whole global financial and economic system is dangerously unanchored. People can do whatever they want, and they are. And lastly, in the event of something going wrong in this non-system, there is no international lender of last resort. So if things go seriously wrong, particularly the big country, you're on your own. And I don't think that's the right way to run an international monetary system. Well, we have a very distinguished panel today to talk about these issues. We have Claudio Borio, who is, I'm pleased to say, my old colleague from the BIS and is now chief of the Monetary and Economics Department. We have Anton Brender and Florence Pisani, who are professors, amongst many other things, at Paris Dauphine University. And lastly, we have Hélène Ray from the London Business School. All of these people are well known. And lastly, we have a still more eminent person, Peter Temmen. And I'm not quite sure whether he's going to be another panelist or a discussionist, but whatever he's going to have to say will be well worth listening to. So, Against all that background, let's begin. Claudio, please.
Thank you. Thank you very much, Bill. So given that we don't have that much time, let me jump immediately into the topic. I'll address two questions. First, what is the Achilles heel of the international monetary and financial system? And then, if so, what can be done about it? And I will argue that the Achilles heel of the international monetary and financial system is that it amplifies, and the key word here is indeed amplifies, what I regard as the main weakness of domestic monetary and financial regimes, what I call the excess financial elasticity, or excess elasticity for short, which is their inability to prevent the buildup of financial imbalances. And by financial imbalances, I mean mainly unsustainable credit and asset price booms, particularly property price booms, that overstretch balance sheets, leading to serious financial crises and macroeconomic dislocations. And of course, the great financial crisis is an example of this. Now, this can be referred otherwise as the failure to tame the pro-cyclicality of the financial system, or the failure to tame the financial cycle. And there are basically two manifestations of this. The first is the simultaneous build-up of financial imbalances across countries, often financed across borders. And secondly, what I would regard as overly accommodative aggregate, that is, for the world as a whole, monetary conditions. That is an easing bias, which is expansionary in the short term, but contractionary longer term as the financial imbalances unwind, and we've seen that in spades with the great financial crisis. Now, a corollary of this is that when thinking about the weaknesses of the international monetary and financial system, and going a little bit back to what Bill said, I think we should really focus much more on financial imbalances as opposed to current account imbalances, which is really what the G20 is largely about. So if you take this diagnosis as given, then what would be the solution? Effectively, what we need to do is to anchor the system more, which is really what the G20. This requires steps at the domestic level, at the international level. At the domestic level, what you have to do is to put your own house in order. And that means putting adequate anchors in individual jurisdictions, and that requires changes in monetary policy, in prudential policy, and in fiscal policy to deal with the financial cycle. And secondly, we have to go one step further and to put the global village in order. And that means putting in place adequate anchors on the interactions of the domestic monetary and financial and fiscal systems, and which means internalizing the externalities of individual countries' policies. If I look at what has been done since the crisis, I would say that just some progress has been made with regards to step one, but hardly any has been made with regard to step two. So the structure of my remarks, I'll say a few words about what's the key in the nature of the weakness, this excess elasticity, both domestically and globally, and then suggest a way forward. Now, let me stress that there are plenty of graphs in my presentation, just to make clear that whatever I will be saying is documented, is based on longer term research. But for the sake, given that I have so little time, I will.
15 minutes.
Yes, I will. So you can look at the graphs later, and you have to try and follow the reasoning as I go along. Okay, what is the source of the excess elasticity in individual economies? Well, excess elasticity ultimately arises from three factors. First, from limitations in economic agents' perceptions of value and risk, which are not very well anchored. They tend to be extrapolative for a number of reasons. Second, from limitations in those agents' incentives to take on risks, and which produces a wedge between what is individually rational and what is desirable at the aggregate level. And familiar notions here include herding, prisoner's dilemma, coordination failures, and the like. And importantly, then, from the interaction between these two limitations and very weak financing constraints, which give rise to the strong self-reinforcing processes that I was telling you about. You have very low and protracted buildups of risks, which then materialize later on, creating crisis. And what is important to realize here is that the financial cycle that we are particularly interested in at the BIS is much longer than the business cycle, which is really the focus of policy. It's about twice as long, given policy regimes. And this is the second important point, that the excess elasticity of an economy depends very much on the policy regimes in place. And it has been amplified by liberalized financial markets, which weaken financing constraints, by monetary policy frameworks that are very much focused on near-term inflation control, which provide less resistance to the buildup of financial imbalances, because unless inflation goes up, monetary policy doesn't get tightened, and paradoxically by positive supply-side developments in the world economy, which provide fertile ground for the financial boom, because you expect growth to be much stronger in the future than it has been in the past, while at the same time putting downward pressure on inflation, so that monetary policy doesn't need to be tightened. Now, how does the international monetary and financial system amplify all this? Well, it does it in two ways. First of all, through the interaction of domestic financial regimes. And by that I mean that financial capital moves freely across currencies and borders. And specifically, this adds an external, you can think of it as the marginal source of finance. External credit tends to outpace domestic credit expansion during financial booms, when the financial imbalances are built up. And by making exchange rates subject to the same type of overshooting to which domestic asset prices, like equity or property prices, are subject to, and for very much the same reasons. And the second way is through the interaction of domestic monetary regimes, which effectively generalize the easing bias from core economies to the rest of the world, and hence the risk of the buildup of financial imbalances. And that happens two ways. First of all, directly, because the currency areas extend well beyond national jurisdictions, particularly in the case of international currencies, and of course in the case of the US dollar, so that what the United States does, for instance, or what happens in those jurisdictions when it comes to monetary policy, has a direct effect on financial conditions elsewhere. And probably even more importantly, this happens indirectly through, I would say, natural resistance to exchange rate appreciation in the other countries, because this implies that policy rates are going to be kept lower than would otherwise be the case, which of course will have an impact on the whole domestic yield curve. And it will also mean that unless you keep interest rates lower than would otherwise be the case in order to resist appreciation pressures, what you can do, of course, is to intervene in the foreign exchange market and then invest the proceeds in the reserve currency assets, which of course puts downward pressure on bond yields there. Now, together, these mechanisms, the interaction of financial and monetary regimes, result in surges and some collapses in what we called global liquidity at the BIS, and which track this very closely. That is, the ease with which you can finance yourself internationally. And it's here that aspects like your global financial cycle come in. Here, now let me sort of point to, I think it's easy to trace the footprints of this excess elasticity in the historical record. Let me just mention a few points. First of all, the size of financial cycles has grown as policy regimes have become much more supportive. That I mean since the early 1980s, because of the reasons that I mentioned earlier. Financial liberalization, the establishment of credible anti-inflation regimes focused on near-term inflation control, and the entry of China and former communist regimes into the world trade system, which has meant a huge expansion, a huge positive supply-side shock. In fact, a sort of sequence of positive supply-side shocks, which we're still experiencing. That said, the geography of financial imbalances, or the buildup of these financial imbalances, has changed pre-crisis and post-crisis. Now, pre-crisis, the buildup of financial imbalances was mainly in some large advanced economies. And this was reflected also in aggregate cross-border credit flows, largely because these flows are mainly among advanced economies, not so much between advanced and emerging market economies, at least if you take the raw numbers. Post-crisis, by contrast, the buildup has been in a number of countries that have been less affected by the crisis. These have been mainly emerging market economies, but not only, also some advanced economies, particularly those that are commodity exporters on the back of a very strong commodity boom. Again, this has been supported by external credit. Again, there has been a very strong expansion of US dollar credit outside the United States. From 2009, the credit to non-banks outside the United States has grown from 6 to over 9 trillion. That is over a 50% increase in the overall volume. And the change has been that there has been a shift from bank credit to market credit, in the form of securities obtained in capital markets, with the end result that asset management industry has grown in leaps and bounds. And this is what my colleague at the BIS, Hyun Shin, has called the second phase of global liquidity. But fundamentally, the mechanisms have been very similar. Now, despite these differences, and this is the other common factor that we have seen, the common feature of pre- and post-crisis landscape is the fact that we have seen unusually accommodative monetary policy conditions across the globe, regardless of the benchmarks that you use. Conditions that, to my mind, are not conducive to sustainable financial and therefore macroeconomic stability. And of course, alongside those conditions, what we have seen has been strong foreign exchange reserve accumulation. And these are the graphs that basically document all the points that I have just made. So you can look at them later. But there is a graph for each of the points I have made. So now, where do current accounts fit in this picture? And going back to the remarks that Bill has made. Well, I would say the role is quite limited. Now, current account deficits are not necessarily correlated to the buildup of financial imbalances. In fact, major financial imbalances throughout history, some of the main ones, have built up and unwound in countries with current account surpluses. I think the most spectacular case was what happened in the United States ahead of the Great Depression, but also think of Japan in the late 80s, early 90s, the huge financial boom that we had there, and the bust that we saw subsequently. And if I look around the world now, I can see a number of countries, but I think I could just mention China, which summarizes the whole thing. Now, the relationship between current account deficits and financial imbalances, I think, is more nuanced. Clearly, a deterioration in the current account can reflect the buildup of financial imbalances, the strong expansion of domestic credit and asset prices. Think of, for example, Spain or Ireland, just to go back to the conversations that are taking place in another room. And in fact, large and persistent current accounts, to my mind, are a better a reflection of free capital flows that are cause of the problems that we're discussing. And this was true in the case of the gold standard, including also in the interwar years, in the 1920s. Now, if this is the case, three important policy implications follow. The first one is that one should focus much more on gross capital flows and the corresponding stocks than on net capital flows, which is really what current accounts represent. Current accounts are simply the net, they are the tip of the iceberg. Second, one should beware of recommending expansion in surplus countries that are exhibiting financial imbalances, because this is effectively adding to the risk of financial problems and macroeconomic problems later on. This is what happened in Japan in the late 80s, and I think is what also has been done in China post-crisis. And none of this, of course, means that current account imbalances do not matter. They do matter, and they matter a lot, because they can represent a major protectionist threat, and because large current account deficits may increase the cost, if not the probability, the cost of the unwinding of financial imbalances. Now, so much for the problem. What about the solution? Well, as I mentioned earlier, this requires putting in place stronger anchors in domestic and in policy regimes and in their interaction. And putting in place stronger anchors in domestic regimes means adjusting monetary, prudential, and fiscal policy. For prudential policy, it means tackling the pro-cyclicality of the financial system head-on through largely macroprudential measures. For monetary policy, it means leaning against the buildup of financial imbalances, even if near-term inflation is under control. This is what I would call the lean option. And for fiscal policy, it requires extra prudence, fully recognizing the hugely flattering effects that financial booms have on the fiscal accounts because of the overestimation of potential output and growth, because of the revenue-rich nature of financial booms, because of compositional effects in tax revenues, and because of the large contingent liabilities that would be needed, that are being built up in order to deal with the subsequent bust. The banking problems, but not just the problems with banks' balance sheets, but also with households or corporate balance sheets, depending on the precise nature of the problems. And I think just remember what happened in Ireland and Spain when the public debt to GDP ratio was falling during the expansion and when they had so-called cyclically adjusted budget surpluses. If I try and assess the progress that has been made, I would say that the progress has not been enough. Prudential policy has not adjusted sufficient, well, probably has adjusted most through Basel III, the countercyclical capital buffer, and macroprudential frameworks. Monetary policy has adjusted less. There has been some shift, but a very timid shift, and little has been done in practice when it comes to putting in place, leaning against the buildup of financial imbalances if inflation is low and stable. I think the temptation to rely exclusively on macroprudential measures has been too strong. And fiscal policy has adjusted least, if at all. There has been little recognition of the flattering effect that booms have on the fiscal accounts. And this is basically a graph that shows you how you can really underestimate the buildup of the strength of the fiscal position during financial booms. Now, towards a solution, what does all this require in the international arena? Well, of course, it requires moving towards stronger cooperative arrangements. And there are basically two preconditions for this. The first is the better recognition of the externalities of individual countries' policies. This is analogous to the shift from the micro to the macroprudential perspective that has already taken place in regulation and supervision, but that has not taken place in global macroeconomic policy. The idea is that just as no institution can be sound unless the overall financial system is sound, so no country can be safe unless the overall global economy is safe. And this requires a more top-down approach to the analysis of the global economy, paying more attention to shared vulnerabilities, to common exposures, to spillovers and spillbacks, to the reaction function of monetary policies across the world, and a recognition of the endogeneity of the global sources of risk with respect to the collective behavior of countries. And the second precondition is the systematic incorporation of financial factors into macroeconomics. We need better models, and those models are simply not there. Again, progress here has been extremely elusive. There has been some in the prudential area because of the harmonization of minimum regulatory standards and explicit coordination of the countercyclical capital buffer, for example. But it has proved very, very hard in the macroeconomic field, and the G20 has been losing steam, and for the reasons that I mentioned, there has been far too much focus on current accounts. The idea, what is a global imbalances, the term global imbalances at the G20 is effectively synonymous with current account imbalances. So let me skip the risks, although we can come back to those later. And let me just conclude by saying that the Achilles heel of the international monetary and financial system, to my mind, is that it amplifies the excess financial elasticity of domestic policy regimes. That is, their ability or inability to prevent the buildup of financial imbalances and their unwinding. And the focus should therefore be, at the international level, much more on financial imbalances and much less on current account imbalances per se. I think the solution requires putting in place strong anchors on domestic policy regimes and on their interaction, that is, on international arrangements. I think that insufficient progress has been made domestically and very limited progress has been made internationally. Now, let me emphasize that the stakes are very high. I think one big risk that we're facing is that of entrenching instability and chronic weakness in the global economy as a result of the buildup and unwinding of these imbalances, and at the same time, the progressive loss of policy ammunition in the form of monetary policy, in the form of fiscal policy, and possibly even in the form of prudential policy. But ultimately what's at stake, and the ultimate risk, is that of a rupture in the current open trade and financial global order, as far as I can see. Because I think the system has been remarkably resilient to the great financial crisis. But my sense is that if there were to be further problems ahead, the temptation to withdraw from back into trade which is really very, very, very problematic, as well as financial protectionism, national protectionism could be quite strong. Thank you.
Thank you, Claudio. I should have said this earlier. We're actually proceeding in alphabetical order, which is the way that they're listed on the program. So I will turn now to Anton Brender and then to Florence Pisani. But before I do, let me just note that they've just published a book which is called Money, Finance, and the Real Economy, and this has been a paid political announcement. Anton, please.
So I will start with the presentation of our paper, and the idea of this paper is that what we did is look at the mechanics underlying international transfers of savings and how those international transfers of savings are related, in fact, we think, to the recent financial crisis. So what we, as Bill said previously, the global financial system, or what he called a monetary non-system, we think is very poorly structured and is much too rigid to accommodate huge transfer of international savings. So what we will do is just start with two observations that are often overlooked. The first one is, as you know, as is well known, there has been a huge amount of gross international capital flows. And if you look at 1995 compared to 2000, those capital flows at the world level have really exploded. This, however, has coincided with something that is often overlooked. It coincided with an increase in world current account imbalances. So it coincided with an increase in international transfers of savings. So that is the first point. And the second point is that this rise in international transfer of savings also coincided with something that is often overlooked. It coincided with a huge acceleration of growth rate of emerging economies. Now, if we look more closely at emerging economies, what appears is that these transfers, this increase in world current account imbalances were very peculiar. It's not because those economies have accumulated deficits that they were able to grow faster, but it's exactly the opposite that happened. It's by permitting those economies to export their excess savings to accumulate surpluses that these economies were able to grow faster. So here, what we did is look at current account in emerging economies on the vertical axis, and on the horizontal axis, what you have is growth of emerging economies. And you clearly see what happened from the mid-1995 to 2006. You had both an improvement in current account of those economies, while at the same time, the rate of growth of these economies accelerated. So it's by permitting these economies to export their excess surplus that, in fact, they could have growth rates that accelerated. In fact, for many of the emerging regions to mobilize their full growth potential, they have to succeed in exporting their excess savings. It's quite easy to understand if you think about oil exporting countries. When oil prices rise, all of a sudden, those countries have a lot of income, and they cannot spend all this rise in income domestically. They don't have the ability, the capacity to process all this rise of income domestically. So for them to continue to grow, they need to export their excess savings. Now, it's also true for some manufacturer exporting countries like China, which had a rather primitive financial system and which were developing rapidly. When you developed rapidly, and there are other stories, other papers going in the same direction, forchery and pescatory, when you develop rapidly, you have a tendency to have a rising saving rate, and it's very difficult for the country to process domestically all this saving. Now, for this, however, for these manufacturer exporting countries to be able to export their excess savings, however, those countries had to manage their exchange rate in a way that would allow sufficient rate of growth of their exports, while at the same time, those economies were accumulating growing current account surpluses. And here, what we did is just look at emerging economies, and we had a measure of over or undervaluation of the currency. It's based on relative purchasing power parity and corrected for the development level. And if you look at the global picture for emerging economies, what you observed is that those economies managed to reduce the overvaluation of their currency. When you moved on the horizontal axis from the right to the left, you reduce the overvaluation of your currency. And when you reduce the overvaluation of your currency, well, generally, it allows you to have a rising current account surplus. So, of course, there was some currency adjustment, some currency management by this country. So what's important is that we think that financial globalization has provided a degree of freedom to the system because it allows countries that have excess savings to export these excess savings. Otherwise, the excess saving would have stifled growth of these economies. Now, by exporting these excess savings, thrifty economies, in fact, also exported their own demand management problem to the rest of the world. The rest of the world consisted of countries whose financial channels generally were capable of handling substantial amounts of lending, and where agents over there in the rest of the world were more inclined to borrow than in the thrifty economies. To put it another way, the rest of the world had the capacity to trigger the lending, the borrowing necessary to maintain their economy close to potential while they were losing market shares. If the thrifty economies were gaining market shares, the rest of the world was losing market share. In order to maintain their economy close to potential, they had to generate a lot of lending. So financial globalization in this way avoided growth being curbed in thrifty economies, while central banks of the rest of the world, in order to regulate their own economy and to maintain their economy close to potential, helped, in fact, in this system, the world economy to stay close to its potential. So that's the degree of freedom provided by globalization. Now, globalization also provided another degree of freedom because you have to remember that we live in a world where the risk can circulate in the global economy. So the lenders, the initial lenders, are not necessarily the one who will have to bear the risk. And the financial system, the global financial system, allowed risk takers everywhere in the world to take part of the risks that were associated with the lending that were granted. So just to give you an example, during the financial crisis, what we know is that a lot of lending was granted in the US economy, but many risk takers in this system were located in Europe. Europe has no current account surpluses, nor deficit. Europe has a current account balance, but still European banks played the role of risk takers in this financial system. So this system is provided 2 degrees of freedoms. Some countries were able to absorb the excess savings by providing the lending, and then the risk circulating around the world economy could be taken, not necessarily by the people that were granting the loans. Now, this degree of freedom, of course, if it provided a degree, this world economy provided some degree of freedom and allowed the world economy to accommodate this excess saving, but of course, it's not without very serious side effects. So the financial crisis clearly revealed the dangers of that which is inherent to this financial globalization. Why? Because for surplus economy to export their excess savings, you have to remember that others should borrow. And loans, it's exactly the same at the world level. Loans always make deposits, even if the loans are granted in one corner of the globe, and the deposits will show up in another corner of the globe. The problem of this system arises from the fact that the world economy is a non-system. It's a juxtaposition of monetary areas, each with its own central banks, each with its own financial system, with its own financial arrangements. You don't borrow the same way in Spain or in Germany. You borrow short-term. For a mortgage, you borrow long-term in Germany, short-term in Spain. index on short-term rates in Spain. So this is a complete non-system with each monetary areas having its own financial practices. And also you have agents more or less inclined to borrow depending on the part of the world they belong to. So in this world, savings will finance the borrowing of countries whose financial channel transmit the most rapidly and the most forcefully monetary impulses. And these monetary impulses will be mainly transmitted to agents that are sensitive to interest rate movements, namely households. Because it doesn't exactly work as in the textbooks. In the textbooks, usually when monetary policy is, you have a lot of borrowing of firms. Firms are borrowing and transmitting the monetary policy. Well, if you look carefully at how monetary policy are transmitted, monetary policy impulses are transmitted, it's mainly through household propensity to spend. And if you look more closely at the propensity to spend of households, it's not through their financial investment behavior, but mainly through their borrowing behavior. So monetary policy is transmitted very unevenly, and it's mainly transmitted through households borrowing. So to illustrate this, what you have here is what happened during the 90s and 2000s. On the left-hand side, you have what we call the thrifty economies, and it's not only emerging economies, it's not only China or OPEC countries, it's China, Germany, Japan, the Netherlands, and Switzerland. And what you have here is current account imbalances in these economies on the horizontal axis, and on the vertical axis, the rate of growth in these economies. And you clearly see exactly what we said at the beginning. When those countries were able to export their excess savings, they managed to grow faster. So in this way, the global system provided, globalized financial system provided them a degree of freedom. Now, the counterpart of that is that you had countries who had to import these excess savings. And those countries were, in fact, few. If you look at the deterioration of global deficits at the world level from the mid-90s to 2006, you see that just 4 countries, the current account of just 4 countries, explain 3/4 of the deterioration at the world level. So what happened in these 4 countries? Well, in these 4 countries, the current account of these 4 countries deteriorated, and this coincided with a sharp rise of household borrowing in these economies. So it's household borrowing, it's the way monetary policy was transmitted most forcefully, that explains the deterioration of the current account of these economies. Unfortunately, there were a huge concentration of borrowing in just a few countries. So we live in a very peculiar world where borrowing of just a few countries, of households of just a few countries, enables income, in the thrifty ones, to grow more rapidly. Now, this was, of course, unsustainable. More loans were granted than was reasonable. And we think that this is, of course, related to what Mr. Borio just said before, to the financial, to the excessive elasticity of the financial system. The system is procyclical by nature. Lenders tend to be procyclical. They lend more when things are improving. And their procyclical nature led to a sharp downward revision of risk aversion, and this triggered a lot of borrowing, much more than what was sustainable. Now, the second danger of this transfer of saving, of course, is related to the circulation of risk in this global financial system. Okay, so I'll skip because I will be too long. What we believe is that still learning lessons from this episode are important. Why? Because for a couple of more years, saving will remain potentially abundant at the world level. Remember that we have a lot of fast-growing economies, and this potential surplus can either be a hindrance for world growth or, as the opposite, could act as a fuel to world economy. Up to now, it was more of an hindrance. If we look at what happened since 2011, what you have here is the forecast of current account balances of emerging countries made by the IMF in 2011. And you see that at that time, the IMF was forecasting growing current account surpluses in emerging areas. And the rate of growth associated was a nice pickup of growth in emerging economies, close to 7% from 2012 on. Now, what happened? Remember that the US current account surplus was reduced during this year, that Europe moved from a current account balance to a current account surplus. So you had nobody to provide the counterpart for this potentially available excess savings. What happened is very clear. These savings did not materialize. At the end of the day, you had much less current account surplus in these economies, and this was, not surprisingly, associated with much weaker rate of growth. So the paradox in the world we live in is that there is substantial potential of savings at one hand. There are also obvious investment needs in the global economy, but for lack of financing channels, these savings cannot flow from surplus economy to the economies needing the investment. The other conclusion is that relying just on the financing channels of just a few economies in order to process those transfer of saving is very dangerous, because when these channels are saturated, the borrowing will stop. And the second thing is that the problem of this financial system is that savings will always flow to the same places. When we have too much saving, it will always flow to the very limited financing channels that the world economy has at its disposal. So if we want to manage the global monetary constraint, which is holding back world growth, we have to build new financing channels if we want to avoid the disaster that we just went through.
Anton, did you want to add anything to that? No, that's fine. Okay.
All right, so while my slides are being set up, let me say that I will start by showing you some simple graphs on our topic of today, which are global imbalances. And here we go, here they are. So unlike Claudio, here are the simple graphs of what we are discussing, which are these famous global imbalances. So here are the proportion of world GDP. You see these are the current accounts of various parts of the world. What is striking here are the bars below zero, which are mostly the US current account deficits. And then some of the bars above zero, which are the current account surpluses, which have been most talked about, are China, which you can see in this kind of delicate purple color on the top. And then you have some oil producers, which have become very important, especially before the 2007 crisis. Japan has always been also kind of a surplus country, an important one. And then some emerging Asia countries have also provided some surpluses to make up for the deficit of the US. So people got quite interested in those issues because, as you can see, and as was pointed out by both Claudio and Florence, you see that up to the run-up of the crisis, we have seen a widening of these imbalances between the various parts of the world. Now, in a kind of contemporaneous way, a very interesting phenomena has also happened, which has been a decrease in the world real rate. So here we have the world short real rate, you have a US long rate, you have a 10-year TIPS, and you see that there is a very kind of parallel descent here towards the negatives. This is also happening in a lot of advanced economies. You would have a very large correlation among long-term real rates in advanced economies. Now, these sets of facts should be complemented as well by what happened to economic growth. So we have seen the period of the so-called Great Moderation between 2003 and 2007, with no inflation, with massive bubbles in some countries, a lot of bubbly wealth. Again, remember this household debt level that increased massively in both the talks of my former colleagues before. There was some growth during that period, and there was some, more importantly, a lot of growing leverage in a number of countries. Actually, it was quite a widespread phenomenon. Now we know about the financial crisis, and then ever since, depending on the parts of the world you are in, we are in something like a great recession with maybe some weak recovery. And monetary policy, that's the big thing, hitting the zero lower bound in advanced economies. Now, what that seems to mean, at least this is one of the favored interpretation of a number of people, is that the equilibrium real rate has been or is still negative. What is the equilibrium real rate? It's the rate that would be consistent with full employment of labor and capital. Now, so what is monetary policy doing in such an environment? Well, it's trying to reach, this equilibrium real rate. So we are decreasing the nominal rate. We cannot go much below zero with a nominal rate. So we're kind of stuck with going, if we have an inflation target of 2%, going to at most like -2. Not clear we get there. In a number of areas, we are in mild deflation. So actually, the realized real rate is actually positive instead of going towards this equilibrium real rate, which is negative. So that's one interpretation of what is happening. Not that absolutely not inconsistent with what Claudio was also discussing before, because if monetary policy is trying to do that, one of the side effects of monetary policy might be indeed this excess elasticity of credit creation everywhere in the US, but also around the world. There are indeed, as Claudio mentioned, this kind of potentially massive spillovers of US monetary policies on international financial markets, which drive something like a global financial cycle in the world economy, where you can see a lot of credit creation, which is synchronous. You could see that in the run-up to the crisis. You can see massive co-movements of capital flows. You can see massive co-movements of asset prices. And these massive spillovers of monetary policy are obviously not internalized by the Fed. If they are spillovers, that means they're not internalized. And this is where we can talk of this international monetary non-system that was mentioned by Bill in introduction. So these kind of two views of what is happening may be not inconsistent. But so here I'm going to focus mostly on this story about this equilibrium real rate, what is going on here in savings and investment balances internationally. Very interesting development that was touched upon by Florence is that actually if you look at these global imbalances in the very recent years, yes, they have come down, for example, because China's current account surplus has just gone down. That's absolutely clear. The oil prices are doing something to oil exporters. The surpluses are also coming down. What is interesting is that if you take Germany, which is this dark blue line here, Germany is kind of the new China, in the sense that its current account surpluses have been kind of widening, and they are pretty big, both in relative terms and in absolute terms. You see the United States, the deficit has reduced a bit, but it's still there. All right, so now I'm going to give you some interpretation of these facts, which I think are pretty first-order facts in international macroeconomics, and I'm going to build on the views of relatively highly visible people. One is Ben Bernanke, who has discussed the global savings glut, and then I will contrast it a little bit with also the secular stagnation view of Larry Summers, and then I will add something. All right, so the global savings glut. So what's going on here? We are trying to explain this pattern of decreasing real rate as well as this pattern of international capital flows. So there are excess savings in some parts of the world. They translate into capital flows from excess savings countries to which are also surplus countries from a trade side to trade deficit countries. So these are these global imbalances we have seen. And if desired savings exceed desired investment, this put pressure down on the real equilibrium real rate. Now, what are these excess savings? Well, they can be driven by conscious policies by government. This would be, for example, China accumulating foreign exchange reserves. This could be a reaction particular to the East Asian crisis of 97-98. And then that can be followed up by export-led growth strategies with undervaluation of the real exchange rate. You've seen that quite clearly in the previous presentation. There's also some interpretation, indeed, of countries which have a lot of savings and which don't have investment capacity at home. So Insufficient development of financial markets is also a driver of excess savings towards other financial markets. And finally, this is probably especially binding this type of consideration. Oil and commodity exporters, you have a positive terms of trade shock on oil. You don't have much investment capacity at home. What's going to happen? You're going to run huge surpluses and export your capital abroad. And obviously, when the oil price goes down, which is what is happening now, we see something going in the opposite direction. Now, if we think that China has integrated in the world economy gradually in the recent past 2 decades or so, then China being a country with very underdeveloped financial system, a lot of excess saving, precautionary savings, for example, this is going to lead to, in any kind of model of international macroeconomics, you have a country with a lot of precautionary savings or a lot of savings for policy reasons. You integrate it in the world economy, this leads to a decrease in the world real rate of interest. And capital flows from the excess saving country to the rest of the world. Now, what is interesting here is to ask ourselves, okay, what was, so maybe that is what exactly has been happening in this long decline of world real rates that we have seen can be explained by these saving gluts. The puzzle that Bernanke and also Summers have also been trying to answer at the same time is, before the crisis, we had all this housing wealth, this bubbly wealth that was created. So we had a lot of over-indebtedness of households, debt overhang all over the place, and yet the economy was not overheating. Okay, you would have thought by all these wealth effects, these valuation effects were tremendously positive for households. In an economy like the US economy, you would have thought that would heat up the economy. Like consumption would increase a lot, investment would increase a lot, and we didn't see that. We saw low inflation, we didn't see that. So what happened during this period, 2003 to 2007? And both Bernanke with the global savings glut and Larry Summers later, I will show you, have an answer to this question. And the answer of Bernanke is, well, you didn't see it. You didn't see the overheating in the US economy because actually this excess demand was used to buy imports. So there were these massive current account deficits. And so 6% of the domestic demand, roughly at its peak, was diverted towards import. So this is why we didn't see overheating in Bernanke's view, despite the large bubble in the US. So this was the global savings glut view. Okay, now let's go to the secular stagnation style view, which is a bit of reinterpreted by Larry Summers. This is not the original secular stagnation of Hansen view. So there, what do we say? Again, we have the same set of stylized facts, and we are wondering what's going on with these big imbalances and this low equilibrium real rate. And here we are going to look for the answer on the investment side. We are going to say, well, the reason the real interest rate is low is not a global savings glut, is because there is low investment. And there is no investment. Why should it be so? Well, because it could be slow population growth. That would be more like the original secular stagnation stuff. But that could be slow technological progress. It could be actually, and that might be the culprit, that there are very strongly declining relative price of investment, relative price of capital compared to consumption goods. And so, when you invest in ICT and all that stuff, the price of this goes down a lot. So in nominal terms, you don't need to invest that much to actually build your capital stock. And there's still the same story that this lack of investment, or this decline in investment relative to saving, desired investment relative to desired saving leads to a negative equilibrium real rate, and monetary policy is constrained by the lower bound, so we have problem to get it. So is there some data backing up the lack of investment? Well, if you look at nominal investment over GDP ratio, this is what you get for a number of advanced economies. So indeed, there is some view that investment as a proportion of GDP in nominal terms has gone down sizably over the period. Now, in such a world, so you have excess desired savings compared to desired investment. This is like a global shortage of demand. And if you are a country with an undervalued exchange rate, you're going to benefit if you undervalue your currency. You kind of drive demand towards yourself. And in such a world, so if countries such as China or Germany, just to give two big current account surplus countries, do that. But at the same time, the borrowing countries are pushed towards austerity or contraction in aggregate demand, then this is exactly the problem of adjustment that Keynes feared in the IMF when the IMF was set up as the scarce currency clause problem, and you push the global economy towards contraction. So that's another interpretation of the data, which is based on the investment side, and not necessarily totally incompatible, as I said, but still pretty distinct. Now, the interesting thing about this debate, which we can call the Bernanke-Summers debate, even though a lot of other people have contributed to, is that you have it gives different clues as to what will happen or what could happen for this decline in real rates or real equilibrium rates to kind of come back up. So on the global savings Gluts view, what you would need in terms of getting this equilibrium real rate back up is to have some of these countries, like China, who have been exporting a lot, who have been accumulating assets a lot, you need them to rebalance. So this would be accompanied with a real revaluation of the RMB in China that would be rebalancing towards domestic consumption. We've seen some of that, so some of it is happening. For the oil exporters, it's easy. You need the oil price to go the other way. So you need the oil price to go down, to remain low where it is now. And so you will get, it's a negative terms of trade shock, negative wealth shocks for these countries. And so that should affect their export of capital. And then, of course, there's the new role of Germany was been expanding on the surplus side. So this, you can interpret Germany as benefiting from indeed a very undervalued real exchange rate within the euro area, and so running a big surplus through that channel. So whether this is going to be changed by the new wage settlement in Germany remain to be seen. So this was the global savings Gluts view, which gives you a fairly interesting set of facts to look at. And what about the secular stagnation view? Well, in that view, we are, the deficit on the investment side. So what would help from that point of view would be some kind of fiscal stimulus. And a lot of people have suggested infrastructure investment in particular. Of course, if technological progress were to pick up, unlike the Bob Gordon view, then that would also help, or the relative price of investment would go up again. That would also change potentially things. On this side of the debate, not well articulated into economic theory yet, there's potentially also some role for inequality and asset price bubbles and how the two interact, because who is investing, who is savings, how the distribution of income affects these two things is clearly potentially an important factor. We are not very advanced in modeling heterogeneity in our models there. Okay, so this is, I think, an interesting debate, and as I said, this is kind of a debate on the real rate, and it's fully compatible or consistent or complementary with the view that we discussed, or Claudio discussed, also on the monetary policy side and the excess credit creation. Now, I would like to add some other twist to the debate in my last minute, if I have. I have 1 minute, okay. So just want to say that I think something that is still missing from this, in a more structured way from this debate on both secular stagnation of global saving Gluts is the importance of the role of the United States at the center of the international monetary system. And this role, I think, you can assess only if you look at the external balance sheet of the United States, which implies looking at gross positions rather than looking at net positions. So it's always important, as Claudio said, to look at gross positions as well as net, or gross flows as well as net flows, because there's a lot of information on these gross flows. Now, I won't have time to discuss the data here. I just want to say that the US, being at the center of the international monetary system, has a fairly specific balance sheets with a lot of safe debt on its liability side, which is held all over the world, and a lot more of risky assets on its asset sides, so this is the US investments in the rest of the world. This means that it's a very specific balance sheet which gives the US an excess return on its net external position because it invests in risky assets. It issues safe liabilities like a banker, okay? But I would push it further. It's not only like a banker, and here you have all the documentation in the data on this external balance sheet position. It's also like a world insurer. Why is it a world insurer? Because think about it. You have a portfolio of an intermediary which is very risky on the asset side, very safe on the liability side. When you have a global financial crisis, what happens? All the risky assets collapse in value, and the safe liabilities, the reserves that are held by all the countries in the world, actually go up in value. You also see it in the dollar going up, but also the value of the US Treasury is going up during global financial crisis. So what does it mean to have an asset side collapsing in value and the liability side going up in value? That means it's a gigantic wealth transfer from the US to the rest of the world during global financial crisis times. So this is the role of an insurer. And so one interpretation of the pricing of assets and the role of the US in the international monetary system is that of a world insurer, in which during normal times it gets some kind of insurance premium. This is the exorbitant privilege, excess return on its net foreign asset position. And in global financial crisis time, it provides transfers to the rest of the world. This is a kind of insurance payment. So if you think about it this way, that has another twist to why country or the external position of countries and the pricing of assets. And you notice that it's all about gross positions here. It's not necessarily about net position. So I don't have time to go into that, though I would have loved to show you that the German net external position has been increasing a lot, but actually the return on German investment abroad has been going down. So when you look at valuation effects, there are some losses here. But in any case, I'm going to conclude by saying so I think it's interesting to think of these two, secular stagnation and also global saving, Gluts view, to understand movements in real interest rate. They have pretty distinct implications. But I think we should also not forget the very specific position of the US as this kind of a global insurer or global banker.
It's on the German thing. I was reading something, I think it was a colleague of Claudio's, Bob Macaulay, and some colleagues, who estimate that the Germans, if you accumulate the current account surpluses of Germany and compare them to the net foreign assets, the Germans have lost 30% of their total investments over the course of the last 10 years.
Okay. Bill, this is the graph I was showing. So actually, this is exactly the graph I was showing. I was accumulating the current accounts of Germany, and the other line was exactly at the valuation of this, and you could see that clearly there was a big loss in values of all these assets.
I guess the moral is that saving doesn't always prove to be, at least beyond a certain level, it's not necessarily a good idea. Okay, let's go to Professor Temmen, and I'm not sure whether this is as a panelist or as a discussant, or just feel free to say whatever you'd like to do, Professor.
Thank you. I'm going to, first of all, I'm a commentator, so let that be stated right at the sense, because what I want to try to do today is to try and pull these three papers, all of which are interesting in their own way, but each of them, of course, written by a different person or people. And of course, I'm a further different person, so we get a complicated kind of set of approaches. But what I'm going to try to do is to try and synthesize the earlier papers by abstracting a bit from them into a story. And I think I can, in this way, come back at the end to the Borio statement about excess elasticity to tie that in with this whole story. And I believe that this whole story begins with something that I have called export-led growth. And since I'm an economic historian, I'm going to take you back to the 19th century, further back than any of these papers go, to try to understand a simpler version of this story, and then we'll bring it up to the current kind of problems. Okay, the 19th century, you recall the growth of industrialization, initially in Britain, which then spread to the continent, and then largely in Germany. And there's the famous crossing of the courses when Germany begins to export more than Britain did of manufactures. Okay, at the end of the century. Now, how did they do this? Where did the exports come in? And that's because the growth of production preceded the growth of consumption, that the countries couldn't handle this. And so they adapted this export-led growth, which worked very well, so that it was financed by a set of bonds and so on, which went well, a much simpler financial system than we have today. And it started with the English export of capital, and so England accumulated this large savings. And so since the previous paper ended with people losing their savings, of course the British lost their savings, or excuse me, utilized their savings to fight the First World War. So lost, gained, however you want to say that. But it didn't go like the paying of a bond for that. The Germans then followed this in the 19th century, and of course also had their asset position chewed up in the First World War. So the accumulation of balances, this kind of financial kind of edifice on the 19th century growth kind of all vanished in the First World War in extremely complicated ways, which I'm not going to go into. But that's the losses. Okay, then what happened in this kind of thing? As all of these papers have emphasized, if you're going to run an excess balance on the current account, you're going to be an exporter, it has to be financed somehow, so there needs to be a financial system in this. Now, the financial system provides paper assets, which are not as substantial as, say, cotton textiles or steel for buildings, and so on, and they are being held for future returns. So anytime you talk about the future, you have to talk about risk. And so these financial assets also hold on to the risk. Now, there's a lot of talk in these comments about the recent years about the risks and who bears the risks and so on. And the reason to go back to the 19th century is because we have a much simpler system and we can kind of say who bore the risks, not the risk of the whole portfolio, which disappeared in the First World War, but along the way. There are numerous kind of cycles, crises, during the period there. And so these represent losses to people taking risks, things that didn't work out, sometimes just lack of balance at times, sometimes because of bad bets for things. But people took losses in that. And in the 19th century, this seemed to work well, that people taking their losses didn't impede the overall trend of economic growth, and we look back on that as a golden era of the economic growth as the technology spread around, and so on. But we can then distinguish these two parts of this as we think of this, and maybe just, even though this is not what the words are defined to mean, but we can look at it as a way of talking to simplify what we're doing. The current account problem is the export-led growth going on. The capital account problem is who holds the risk. Okay, so now let's come up into the 20th century, and we're going to skip over the first half of the 20th century and go really toward the end of the 20th century for this. And then, as papers have commented, that the current account, the export-led growth, has been coming a lot from developing countries, coming largely from Japan and then from China. Other countries are there, as was mentioned in the papers, but quantitatively these were the big savers in the point there. And so they exported the capital, and then the question comes, okay, that's fine, that's export-led growth, it's the expansion of industrialization, now not from Britain to Europe, but then from Europe to Asia, and so this is should be a benign kind of situation. But of course, when we go to the capital account side of it, we have the question of who's going to hold the risk, which each of these papers has talked about in its different way. And we have now a much more complicated financial system, which in its design is to allow the risk to be borne by people who want to bear the risk. However, in its application, turns out there's more than enough risk to go around than there are people who understand the risks to go around. And so people hold these things on really unrealistic promises of one sort or another. And that, of course, gives rise to a crash. And so what we have here is a crash which in the closing things of Helen's comments threaten this whole system of allowing countries to improve their economies, adopt new technology, export things, so to give them time to go for, to bring their domestic consumption up at a much later time. And so this whole process has gotten into this very large crisis that we're now still in. And as Elaine said, it seems to be threatening growth. In other words, it's not kind of the crisis of the 19th century where you have a crisis, you get over it, you go back on to growth, but it's where it does this, and so everybody's talking about global glut, savings glut, or secular stagnation, or things like that. And if we take this back into the 19th century again, take that model of what's supposed to happen, what's supposed to happen is people are to absorb the risks, take the losses, then there are lots of economic opportunities around, begin this process essentially over again of allowing for current account surpluses to export the goods that people now know how to market to other markets. and then finance this to go on, until the next crisis, but to go on with the resumption of growth. And what we have at this point seems to be that there doesn't seem to be anybody who's willing to do this kind of picking up and going for the next wave of economic growth and even full employment, if we don't worry about the long-run implications, but then the short-run implications. And the question then is, why is this? And I think this comes then back to the Borio concept of excess financial elasticity, that the attempt to articulate the financial system to allocate the risk so precisely that only the people who wanted to take risk would take risk, which would improve the efficiency of the financial system to match the increasing efficiency and productivity of the real production in the current account side of this kind of thing, has somehow gone wrong. That we had enormous cancellation, expansions coming in. And there I'd like to take a comment, and I can't remember the Brender Pisani paper was talking about the long-run growth, export growth. I guess Helene was talking about the distribution of income kind of thing. That I'm now going to tell a U.S. story because I know more about it, but it's clearly happening elsewhere in this situation. That in this risk-bearing part of this allocate, I don't want to call it risk-bearing, it's the assumption of risk and the allocation of risk around. We had the growth of taking kind of ordinary assets, as was said before, housing in this, where you got a mortgage, and that was a straightforward thing, gave it to a bank, and they held it, took the risk, and so on, and diversified by having many mortgages. That's still done by local community banks in the United States, by the way. But on the scale that we're talking about here, that was done by large financial institutions which securitized the risk, bundling them together so people had packages and they could take. Now, what drove that system in the United States, and I'm going to say this, it may be happening in the rest of the world, but I'm just going to limit myself to the US because I know something about it in the modern thing. This was affected very much like by the distribution of income. And so what you had was an increase in the borrowing by people on real estate, on houses, to finance consumption rather than investment, because their incomes had stopped growing, and so they wanted to have more consumption. And so what happened then, as you got more finance coming, and I don't have enough time or enough ingenuity to do this on the fly to put this into the international kind of setup there, but you can see what's coming is the notion that since there was all the borrowing coming up, but not the growth of productive investment behind it, there was just the growth of consumption on it. You got then, in some sense, a kind of decoupling between all of the risk allocation and the real economy. And when that happens, of course, you can get a crash, which we had. What distinguishes this crash is that these securitized assets were sold in Europe as well as in the United States. Then, when the crash came, were guaranteed. Who was going to take the loss? Well, the banks made the policy was that governments would rescue the banks, that is to say, take on their losses. So you had the growth of then national debts coming in. So that it appears today as if nations have been borrowing, but that's the effect of the short-term crisis that came from this longer-run process, which in recent years, with this excess elasticity, has in a sense become an industry of itself, rather less connected to the real economy. So just to close, because I've spoken for too long, which is what happens to me when I don't have the discipline of slides, since I got things recently, is that we're in a position in which the question of the losses from the crisis, who is going to take the losses, has yet to be resolved. And so there are lots of struggles going on about that. And then what that has done with that is to lead to decline of investment as people wonder who is then going to be in the position to have absorbed the loss and can finance the new investment. This is happening kind of within countries in Europe and in America, and that is coupled with the Asian countries beginning to, this is a pejorative way of saying it, but I'm short of time, growing up, kind of becoming the kind of mature economies that we know from Europe and America, the developed world, in the second half of the 20th century, so that they're promoting domestic consumption for this. And so they are not doing all of the investing at this point to grow the economies going there, because they are financing their own internal domestic thing. And so the graphs, and I don't know which graphs, but they were fine graphs about the current account balances going down. All of these were insightful because it means that this older process of allocating, of allowing the people who are ready to grow is broken down, because there isn't any country or group that right at the moment is standing up in this category of going for it. Now maybe, we haven't mentioned India at all, maybe that would go, Brazil, something other than that, but the existing way of doing it has broken down, and this resolution of the risk part of it is still ongoing, which is inhibiting dealing with what I call the current account problem. Thank you.
Just picking up on that last point, Professor, which I thought was very, very intriguing. I would suggest that there's been an unwillingness for at least a couple of decades to accept the costs associated with economic downturns. And therefore, the use of macroeconomic policies has grown ever more vigorous, and this goes back to the 1980s, to prevent these downturns from occurring. Over the course of the years, I think you're absolutely right, the growing complexity of the financial system has also meant that if you were to have a downturn where the losses can no longer be hidden, it would be a very significant downturn. And so people are growing more and more apprehensive of that happening. And so therefore the resistance to that happening gets greater and greater. And I think at the moment, the problem is that we've played this game for over 20 years. And so many of those losses are out there but unrecognized that in a sense what we've done is we've substituted, we gain short-run stability, but I think only at the expense of longer-run instability. And as I said right at the beginning of my remarks, I don't think this thing is over yet, given the debt levels that are still out there. I have a comment from the floor. Other comments from the floor? And at the end, I have some last comments on what other people have said. Please.
Can I just pick up on what Peter said, because I think it creates a framework to think about the three papers. Peter's framework of export-led growth very much encapsulated the Florence's paper, and I think it's a framework to think about it. I also think it also connects with the other two papers rather well. Let me put my point precisely about Europe. It's a general one, but let me do just Europe. We heard Mr. Varoufakis talk just before this about what he described as a perfectly constructed European Union in which debts and banking responsibilities would be allocated to the particular countries involved rather than generalized. Now, couple that with Peter's story and try and understand what Europe was meant to do. It was set up to enable export-led growth in Southern Europe. Transfer of technology, get rid of policy risk, old-fashioned stuff, get on with it, and lend from the north. Germany wants to save, and export-led growth. And you do it for 10 years. And Peter's general story is at the end, this always collapses somehow or other. Well, Europe's perfectly designed to keep the risks in the south, and the south are now perfectly determined not to accept that. And we're watching a 3, 4, 5, 6 year long struggle that's not over yet about who bears the risks. Furthermore, it's doubly complicated. And just to compare it with Thailand, where you had 10 years of export-led growth, 1997, currency collapses, imposes huge losses on the foreigners who've done FDI in Thailand. You manage to reallocate the risks internationally by the exchange rate mechanism, which also enables Thailand to begin to grow again. And everyone complains for a year that the IMF is wrecking everything, and then everyone shuts up and realizes this is all working and is fine. The second thing in Europe is that the reconciliation of who bears the debts is made doubly difficult because the other half of Germany never really believed that this was what was going on. It wanted the European Union to enable German export-led growth. The competitiveness model, well entrenched in German social structure of enabling cost reduction remorselessly, terrific to join a monetary union with other countries that haven't figured out how to do that. We'll do export-led growth. And that's been going on too. That's what the first 10 years was. And now look at where we are, at just the time when you want the South to be able to find a way of bearing its part of the burden to begin to recover. We have an export-led growth north, making it impossible for the South to export. So double cross, all in Peter's framework and connecting up really rather well with the three papers that were given.
Further comments from, where do I start?
Yes, I think that the issue here is that we are in a phase where there is no international governance on these topics. And I think this is the Achilles heels. I wouldn't agree with the fact that excessive elasticity is considered the heel. I think this is a result of the fact that we have, as you said at the beginning, an international monetary policy non-system and an international financial non-system. Secondly, my question to the panelists is, do you think that financial liberalization has gone too far? And do you think that we should go back now to some sort of financial protectionism? And a question to Professor Tamin. how do you think we are gonna solve the fact that we are now in a leaderless economy, as you said in your work? Are we gonna go back to an equilibrium where there is a new leader, or are we gonna continue in a situation where there is no leader until the system collapses? Thank you.
Does anybody on the panel want to respond to the first question about excessive liberalization?
Actually, given the time, why don't we gather comments and let the panelists talk
Okay.
then after.
Okay, let's do that at the end. All right.
They're going to be somewhat
All right. Could you put it in those terms then, please? Let's have questions for the panel, if possible.
It's Eve Smith. In some ways, this may be a bit unfair because this is by nature macroeconomic talk and not as focused on institutions. But nevertheless, there's an assumption in all of the remarks that financial institutions play a benign and largely neutral role of allocating risks from savers to opportunities. And I know Claudio's raising his eyebrows because the notion of excess elasticity is divergent from that. But I would almost say that I would almost argue that that's understating it because it's too polite a nomenclature. If you look at the role that financial institutions have played increasingly, for instance, the derivatives, over-the-counter derivatives basically became a real business starting in the early 1990s. And anyone who has actually worked in that business will tell you that the most lucrative derivatives and the ones with the highest risk, the over-counter derivatives, are mainly used by corporations for the purposes of tax avoidance and accounting gaming, that they're used for socially non-virtuous activities. And banks have been unable to collateralize those with fully safe securities for a long time, so you've got sort of risks floating around that are bound to blow up at some point over time because the safe collateral is, that's one of the, there's these constant complaints that there's not enough safe collateral. What do we need all that collateral for? It's actually significantly to capitalize these derivative positions. Similarly, the story of the housing bubble, at least as far as the US is concerned, is that if it had only been a housing crisis, it would have been maybe a savings and loan level crisis. That what turned it into a global financial crisis was that you had credit default swaps exposures, which were, no one has good numbers, but it's easily 4 times and probably more like 6 times the value of the risky subprime debt that wound up held by significantly fragile and systemically systemically important institutions. So my question is sort of an INET question, that how do you, I mean, I may have a bias that I think the institutional side of the story is very important, and yet the sort of traditional macro view of the world is that you don't have perverse institutional behavior as part of this, sort of story of how you pull the macroeconomic levers, and how do we start getting stories like that integrated into stories like this?
Well, this is, together with the international monetary system, the other thing that's not getting anywhere near as much attention as it should do is precisely that. Going back to questions like narrow banking, the Chicago School, things of that nature. Much more radical, of course, but it ought to be something that we talk about. Sorry, I had one more question.
Neil Lancastle. I wanted to pick up on Borio talking about gross balance sheets. So Luxembourg has liabilities, I think they're about 150 times GDP, which is, as the speaker said before, this is largely corporate saving, tax avoidance, retained earnings. It doesn't really fit the picture of excess savings in surplus countries like China or Germany. It's much more an endogenous process. So how much fragility is there if this is brought under control and these corporate balance sheets are deleveraged?
Major change in terms of reserve accumulation by central banks in emerging markets compared with the previous years. Is it a new phenomenon or is it something transitory? And what will be the consequences of that about the issue of global financial safety net or regional safety net for emerging market at a time of a change of US monetary policy coming soon?
Test 1, 2, 3, 4, 5. OK.
Okay. So I'm referring mainly to Claudio Borio's presentation. I agree with very much of what you said. There's just one thing that really strikes me, namely that we don't talk about fiscal policy in this context at all. And it seems to me that this may be a very important factor. If we go back, really, since the 90s, we started to ask ever more from monetary policy. We decided fiscal policy cannot be used for stabilization purposes. It's too difficult to handle. It's not very effective. So if you don't use fiscal policy anymore, you automatically shift more of the stabilization burden to monetary policy. And I think over time this got even worse, also related to this idea that contractionary consolidation would be expansionary, so we shouldn't really worry about contractionary fiscal policies anymore. Of course, contractionary fiscal policies are just that. They are contractionary, and they imply that we're asking ever more from monetary policy to stabilize economies. And if we ask ever more from monetary policy, it would be very inconvenient if we had a financial system that doesn't respond. So we need a financial system that is very elastic in its response. Okay, so to turn this into a question, why are you quiet on fiscal policy? That's isn't that part of the story?
I guess one part of the answer is this is not a session on fiscal policy, but you're absolutely right.
It is.
We're running out of time. Let's start with Claudio, and I'll ask the people to respond to whatever questions they think they're most capable of responding to.
Okay, and let me sort of apologize before even responding to the questions, because clearly we don't have much time, but I actually will try and take them all very quickly. First one, is the problem a governance issue, and then what does that all imply for should we roll back financial regulation and the like? First of all, I don't think that the problem really is just a governance issue. I think there is a general theorem out there that if you have, as I mentioned earlier, your own house in order, then the benefits from explicit cooperation are going to be smaller. I mean, that's a general theorem. It's an envelope theorem, and it makes sort of intuitive sense. And the problem that I see is that we do not have our own house in order. And the reason that we don't have our own house in order is basically what I was suggesting, that monetary policy frameworks, prudential frameworks, and fiscal policy are not really designed to deal with the financial cycle and its long-term implications for the real economy, which I think are in front of all of us. These are very long-lasting effects on output growth, very long-lasting effects on the level of output, very long-lasting effects on productivity. And indeed, we're doing further work at the BIS to substantiate these points. But I think it's relatively well known. Should we roll back financial integration? I think that the first line of defense is basically to do what I was suggesting earlier, is to get monetary policy right, is to get prudential policy right, and to get fiscal policy right. And by prudential policy right, I think that we need to do a lot on the prudential regulation side to try and make sure that the system is safer. And I think some steps have been taken, but unless you take steps in the other areas of policy too, you are not going to be able to make sure that the system has sufficiently good anchors. The role of financial institutions, sure. I mean, the role of financial institutions is at the center of all this. But I would not necessarily equate the role of financial institutions with all these new instruments that were at the core of the problems in the United States. I think if you look through history and you see this what is really common across crises as opposed to what is different across crises, is that you have these huge expansions of credit that have of asset prices that have very serious consequences for the macroeconomy. And you may have them with a lot of financial innovation. You may have them with less financial innovation, although typically they would go hand in hand. But that will depend very much on what's happening at the time, on the regulation and the supervision that you have at the time, and what the incentives are to get around it. But depending on what the system is like, the manifestations of the same problems are going to be different. But the root of the problem, to my mind, are those aspects that I described before. Luxembourg, 150% of GDP. I cannot stress this enough, and I think that it didn't come out clearly in our discussions, and I think this is something that would merit further attention. But talking about current accounts and saving and investment in that context, and talking about financing, these are two completely different concepts, okay? They're it's like talking about apples and oranges. And unfortunately, in many of the models that we have got used to, the two things are equated because of the structure of the models, not because of what actually goes on in the real world. I can easily have, and we're doing that just to clarify this further, whether you have a current account surplus or not at the global level, and the distribution basically says that I'm saving less. If someone is saving less, that's making room for others to consume more and so on, and to keep effectively within a particular resource constraint. But financing is very different. You can, whether you're a country in surplus, whether you're a country in deficit, whether you're a country which has a current account balance, where the financing is coming from can be completely from elsewhere. Okay? So the two things are entirely different, and we treat them as the same. Foreign exchange accumulation, well, clearly we are in the phase in which everything is being sacked back, because we had a huge expansion in capital flows, we had a huge expansion in credit outside, and now with the possible reversal of US monetary policy, we're going to see that in reverse, and that will imply that foreign exchange buffers are going to come under a lot of strain. And on fiscal policy, I discussed that earlier, so I won't repeat.
I turn then to Anton and Florence.
I would just like to make a brief comment, starting from what Peter said a few minutes ago about the history and so on. What is a pity today is that we're not better placed to handle big outbursts, of saving in the world economy, because those regularly happen. They happen in the 19th century. They happen right now when China moved into the global economy. Those countries are countries that, China is a country that has a huge potential for growth and for saving. And in order to mobilize this potential, it has to export the savings. There is often a confusion between export-led growth and the need to export savings. You can very well have export-led growth and a balanced current account if you don't have any excess savings. When you have an excess savings to export, it will mean that not only you rely on exports to grow, but you need to keep your current account in surplus. And China has been intervening in order to keep the current account in surplus, despite the very existence of this current account, because otherwise the currency would have kept appreciating all the time, which it didn't happen, which it didn't do. Now the pity is that we just lived a repeat of what we saw at the end of the 70s. At the end of the 70s, you had, for other reasons, an outburst of saving in the world economy just because the price of oil increased very sharply and brutally. And the only way to accommodate it was to get those savings exported, not to the Latin American countries. And the correlation between this saving glut that occurred then and the fact that the savings were used in Latin America and financed by the city in London, which very well shows that you can distinguish the excess savings and the financing. It's not the same ones that took the risks, but the savings were wasted at that time. So what we say is that what is missing today in the world economy, and this didn't show, I think we insist on this because people tend to neglect it a bit, is the fact that the pipes, the channels that we use to channel savings from one place to the other have never really been put in place. So we use a patchwork of financial instruments, a financial system, of financial practices that for a while, thanks to this excessive elasticity, because we believe that it helps the world accommodate those outbursts of savings that took place from time to time, thanks to this excessive elasticity, we've been able to accommodate those shocks. Unfortunately, because of this excessive elasticity, each time you accommodate such a shock, it's followed by a huge crash. So we should draw the lessons of this repetition of episodes of exactly the same kind, where you see huge accumulation of savings ending in a wastage of saving, and then in a long, protracted period of economic activity.
Very briefly, starting from the key question that Peter asked, who holds the risk, indeed, and that ties in very well with a lot of questions, because in some sense, who held the risk during the crisis, we saw that it was the institutions which had a comparative advantage in holding the risk. Which were they? They were the banks. Why? Because there was moral hazard, because they would be bailed out if they would come down. So our institutions' importance, are the incentives given to people, the bailout guarantees, the implicit subsidies important? Absolutely. So here you have, I think, some very sympathetic panel to all these issues. Absolutely. Are we trying to put them in our economic models? We are. We are behind, but we are. Rent-seeking behavior, moral hazard issues, opacity of markets. So I think it's, yeah, and it is indeed more broad-ranging than only derivatives. It's all this system of incentives that we have to deal with here. Does it mean we need to have a large fiscal buffer because fiscal excesses, fiscal surpluses are mirages when we have bubbles? Yes, absolutely. It's a key issue, and macroprudential policies can they sometimes take the form of restrictions to capital flows? Yes, I think they can, subset of flows, potentially. So I think all that, we have to work on all this. It's clearly, systemic risk is clearly a very difficult problem that we are beginning to get to.
Professor Timon, I give you the last word.
Okay. Well, the two last words. First, these are three very interesting papers that, as you see, can fit together. So I urge you to get them from the internet and look at all the tables and graphs and absorb this for yourself. But just to respond to the issue of fiscal policy, if the private economy will not generate demand, that was the role of the government. That throws us back to Keynesian economics, so the new thinking becomes, the old thinking becomes the new thinking of this. But governments today seem to be obsessed with doing exactly the reverse. And this session comes to an end with that statement, I think, because we can't go into the reasons.
Okay, may I thank the panelists, and may I thank the audience and people that posed the questions. There are still a lot of questions out there. Some of us may think we have the answers, but we're constantly finding that the things that we used to believe yesterday are no longer true today. So anyway, thank you again, and the session is closed.